Onto your markets news. Asian share markets continued their recovery in today's trade, with Japanese stocks up over 1% at the close, following a 10% gain on Tuesday after a 12% decline in stocks on Monday. This is spurred in part by a Japanese central bank official downplaying the prospect of an interest rate hike. The Nikkei share average rose 1.2%. The Hang Seng Index climbed 1.4%, while the Shanghai Composite Index rose by 0.09%. Over in the United States, U.S. equities surged back in yesterday's session after 3 straight days of declines, which resulted in wiping out the significant gains made in 2024 so far, choosing to push back concerns about possible recession worries. The Dow Jones Industrial Average rose by 0.76%. The S&P 500 gained 1.04%, while the tech-heavy Nasdaq Composite rose by a similar margin, up 1.04%. Well, to unpack the markets for us, I'm joined by Skulk Low. He's a wealth manager at PSG. Thank you so much, Skulk, for joining us. So the factors that saw major market sell-offs around the world have clearly not disappeared. So what's driving the latest positive moves, and can they be sustained critically?
Good afternoon, Mpho. Yeah, and thanks for having me. Yeah, it's been a crazy few days. I mean, we went from absolute chaos end of last week, beginning of this week, to the bull market is back again. So bottom line, I think we had some negative economic data that came out on Friday, and naturally the market reacted and sometimes overreacted. And then Monday morning we had slightly better economic news coming out of the US, and maybe the market just felt that they overreacted a little bit, and we saw this let's call it this massive pullback again yesterday and today. I would be really skeptical. I mean, I know, how did the Hemingway saying go? How did they go bankrupt? Slowly, and then ever so suddenly. This is the first time that we've been seeing, some cracks in the US economic data. And I think, we're going to see more of these type of data, and most probably more of these type of volatility. Also saw the VIX. I mean, the volatility index spike up to the highest levels that we've seen in years. I mean, that's a big sign. And the market just suddenly went into extreme fear. And that's not me saying that. If you look at the CNN, fear and greed index, currently moved from all the way from a very, very greedy market to now extreme fear.
Yeah. So there's been talk about the US Fed needing to hold an emergency meeting about the US economy and ultimately making a call on cutting rates at a faster and bigger pace. Do you think that's likely to happen?
I think Mr. Market is hoping for that, but I don't think that's going to happen. For the reason that I think they would most probably make a policy area then. Because remember, why they're doing this? They're trying to try and combat inflation. And they say history don't repeat itself, but it often rhymes. And when you go back to the late 70s and let's call it the beginning 80s, we had a similar scenario where we had a stimulus and eventually ended up massive inflation. And they were just too quick on that button to start reducing rates again. And by doing that, they had the second tranche inflation. And that second tranche inflation eventually ended up being higher than the first tranche. And which just meant that they had to really be serious. I think the interest rates went from something like 2% to 18% over that preceding 10, 12 months. So I don't think the Fed will try and make the same mistake again. But then again, stranger things has happened.
Yeah, indeed. So of course the Japanese market came into sharp focus because of the way that it fell on Monday, and then it buoyed up again yesterday by 10%, and seemingly today, it's picked up as well, although not to the same degree. Just explain to us in very simple terms around the carry trade and why Japan had such a negative reaction on Monday and why it's improved now.
Yeah, that was crazy. I mean, you just mentioned it, 15% drop in the market, and a 10% movement upward again the next day. Carry trade, in the most simplest way of explaining it is just by saying we're two different countries. In the one country, say, well, we've got pretty much no interest rates. We had no interest rates for years. We most probably won't have interest rates going forward. So people can go and borrow. They borrow for next to nothing, the money. And then what they do is they go to country B. Let's say, for instance, in this case, we talk about Japan. They go and borrow money from Japan, and they will only need, for every 1 rand they go and borrow, they only need to repay, 1 rand and 1 cent. But just let's call it south of Japan, you've got Australia, also a developed country. You can go and invest in their bonds for 5%. So effectively, they take from Peter at next to nothing and go invest from Paul. And the Japanese central bank went like, no. We're also starting to struggle with price increases. We're also struggling with inflation. We're now going to start increasing interest rates for the first time in decades. So they went pretty much from, when you look at the interest rate, went from a negative interest rate, increased it by 35 basis points. Now, why is that important? Because remember, when you increase increase a interest rate, usually that means that your currency should improve. And naturally, if you start decreasing, your currency should be negative. For Japan, when you see an interest rate increase,
Skalk?
that is good. Yes.
Skalk, I do apologize. We do have to intervene. We've got a breaking story. But thank you so much for your time. Skalk Low, he's a wealth manager at PSG.